Hey YouTube, Kent here from Think Trade Profit. In this video, I want to share with you some tips to instantly place better stop losses so that you don't get hunted. And if you stay to the end of the video, I'll also give you some ideas about how that if you're not in a position, you can hunt stop runs just like the market makers do. So let's jump into it. All right, the first rule of stop losses is average true range. You have to consider it. So if you don't have it there already, slap ATR on your chart. You can see it here on mine. I have a 14-period average true range, and this is what I use for every time period. So take the chart, your main chart that you make trading decisions off of, entries and exits, put ATR, 14-period ATR on there, and take a look at it. So what you're going to learn from this is obviously it changes throughout the day. At the open, it's probably going to be the largest value. And as you go into later stages in the day, depending on how the stock trades, it's going to get smaller and smaller and smaller. So you want this on here as a guide. For me personally, intraday trading, I try not to have a loss that is greater than the ATR at any one point in time. There are exceptions, but it's a good guideline to follow. So if you're trading the open, it's going to have a wide value. If you were on Facebook at the open, the ATR is 39 cents. You can see it over here. So that's pretty wide stop loss. So adjust your position size accordingly so that your risk is appropriate for your account. But this is the first guideline. And again, in the first 15 minutes of the day, this is just getting formed. Otherwise, the 14-period moving average is using data from yesterday's close if you don't have extended hours up. And if you do have extended hours up, it's using it from the early morning session, which doesn't have any of the comparable volume that you see after the open. So you have to be a little bit careful with this in the first 15 minutes of the day. But average true range, put it on your chart, and make a rule that you won't take a loss greater than the average true range. And I know that sounds hard, especially early in the day, but the kicker is fight for price. Get really good prices, and this will work for you. All right, the second thing to consider is what I call main levels or round numbers. Now, this is going to vary per stock. If you have very expensive stocks, it's probably going to be a point and half a point, so 0.0 and 0.50. If you have smaller stocks, like I trade a lot of Micron lately, I use the main levels of that of being 0.0, 25 cents, 50 cents, and 75 cents. Price seems to get pulled to those levels, and it's not a mystery. Options are priced on a lot of these levels in some stocks. So looking at Micron today, you can see that there's some bounces here off of the 51 flat level, 51, 51, 51, 51. Up here, this was a 51.25 up here. It was touched multiple times in the morning. But you see what I'm getting at. You're going to have to look at the stocks you trade. If you trade small caps, very small caps, it might be 10 cents. Something that's under $10, you might use every 10-cent level. So in this stock, it could be potentially 7.30, 7.40, 7.50. You can see some turns here. Another thing to look for if you need a clue is look at the options and see where the options are set. So you can do this in Active Trader Pro with Trade Armor. Have Trade Armor up, open it up, go to the options tab. If you have it linked to your chart, it's right here. And you pop this down for, say, buy, call, or put, and you can see where the near-term options are priced. And this one has one at 17.50. So looking at this chart, it's no surprise that this crossed 17.50 quite a few times today. Over here, over here, over here. So you wouldn't want your stop losses in places like this if you can help it. It's a round number. Options are priced there. It's going to get touched, and it's going to get touched there a lot. One more reason to avoid these round numbers or main levels is broker dealers who are working large orders in the marketplace for, say, pension funds or hedge funds or mutual funds. They like round numbers too. So they'll spend the day and they'll accumulate stock, and when they report a chunk of it to them, let's say they're working in order for 500,000 shares of Micron. So they will spend some time, they will accumulate stock, and throughout the day, they'll give a report to the person they're working the order for, and it will generally be a round number. So it'll be, hey, you bought 25,000 at 50.25 or 100,000 at 50.30 and things like that. And what they do is they ensure that whether they're calling them on the phone or reporting it electronically, that the price is trading at that level or a little bit higher when they give them that report. Obviously, they're working a large order throughout the day, so they're going to get different price levels. But you're going to see price push to levels temporarily, like on this Micron chart. pushed to 51 multiple times, and it could be that there's a buyer out there accumulating this, and he just made sure that the stock gets up to this level when he reports that price. He may beat VWAP at the end of the day, and it may not be anywhere near 51. It may be a lot higher, and if it is, he looks great. The stock closes higher, he bought a bunch of stock at 51, and the stock closed at 51.5. But that's another reason. That's why you see these kind of runs to these main levels or round numbers, and then it retreats right off. They report that, and then they go about their business, and they accumulate, buy or sell more stock for their large order. All right, the next thing to consider, and everyone should know this already, but I'm going to say it anyways, is support and resistance. So looking at your chart, let's say we were going to look at this ALDX, and we were going to buy somewhere along this kind of flagging pattern here after 11 a.m. Visually, there could be some resistance here at $7.30. It seems to have held above that except for this little bump here. But let's say 730, it's a main level, so we don't want to put it right there. But also, the resistance is somewhere just a little bit above there too, except for this move. So if you were going to buy somewhere as best as you could between 11 and 12 for the next leg up, you would put your stop for that entry below this level. Not in the middle of it. I saw a very popular YouTuber the other day put his stop loss in right in the middle of all the consolidation of the stock before it had broken out. So he said, oh, I'm going to put it at $10 right in here. If it pulls back $10, I'm out. And it makes no sense. You've got an average true range to figure out. So in this case, at this point in time, when this was kind of forming this area, average true range is about 3 cents. Let's say you give yourself a good price. Plus, you got to give yourself some room underneath this 730 level. So if you bought it after this dip, you know, somewhere between 726, 727, that's where you should put it. Don't put it at 730. Give yourself just a little bit of room underneath support or above resistance. All right, another mistake that I see a lot of people make when placing stop losses is using VWAP, volume weighted average price, too early in the day. So let me show you, this is Micron, I'll just use this as an example. And this chart's a little bit spotty, but here's today in Micron, there's a little bit of yesterday's close over here. So volume weighted average price. Don't use this as a place to put a stop loss early in the day or in pre-market. It doesn't count for anything, and I know this. I used to work with a large broker in the southeast here. VWAP is used by institutions to grade how well the market center, the specialist or the NASDAQ market maker or whoever's working their order is, how well they do at the end of the day. If they finish up a trade, a large trade of 1 million shares, and they did better than VWAP, when they bought it, then they're thrilled and they'll take more business back to the market maker. So with that said, most of the orders don't hit the desk till after the market opens, believe it or not. And a lot of times you really don't see the large orders that are going to kind of drive the price the rest of the day. You really don't start to see those form until after like 10:15. Generally, we have a lot of news and things that happen in the morning. We had a 9:45 news announcement this morning, I think, and a 10 a.m. one. So it's after that you've got these large orders that start to come in. The mutual funds call a sales trader. The sales trader takes it to the trading desk, and then they start working these large orders. So with that, don't give VWAP so much credit at the open, for example. It means nothing. It's not going to be anywhere indicative of where it's going to be at the end of the day or the strength or the weakness of the stock. And I see a lot of people, I've seen it, everyone's got it on their platforms except us at Fidelity. But this is TradingView, and I use this, but just don't give it any bearing about, hey, I'm going to put a stop at VWAP if it goes below VWAP. It just doesn't make any sense. Don't use VWAP super early in the morning. All right, the next thing to consider when placing good stop losses is keep in mind the close of the London Stock Exchange. And this goes back to my currency trading days, but I see this a lot in our markets. What happens is we have a certain momentum off the open. There seems to be maybe a trend set. Things are weaker or are stronger. And what happens between 11 and until 11:30 Eastern Standard Time, 11:30 Eastern Standard Time is when the London Stock Exchange closes. There is oftentimes sort of a mini reversal of the morning action through that period of time. It's like approaching our lunchtime, but it's 11 to 11:30 usually. And the way I see it is oftentimes our market centers, our broker dealers and market makers and the specialists, they try to give the London traders the worst prices possible. So if you think about the context of the morning in that kind of mindset, you might be ready for some of these really strange moves. All right, so looking at Micron off the open this morning, this is how it opened up. It actually opened up lower. The stocks really wasn't strong this morning either. It was pretty weak. It traded down, had a little bit of spike in at 10 a.m. But again, we had some news right around here. I think we had medium level news. It was PMI or manufacturing or something like that. So they used the opportunity of kind of low volume right up in here to push this as high as possible. But it really was weak. And then it traded down after the news. But from 11 to in here, this is 11:30, this thing went on a tear. And so did our SPYs and that kind of thing. And a couple stocks did. If you were in the S&P 500 or the NASDAQ 100, your stock probably did this today too. And this is, I see this a lot. It's this reversal of all this weakness. And international traders do trade our markets. They do place orders with our market centers. They make it really hard for them to stay short, right? This is just a ridiculous move at the time. SPYs really weren't doing that much. And they pushed this way up here. It sat here for a good bit. And then it started to fade at 11:43. So London had closed. Those guys have to go home. And if they were short, they're definitely stopped out of their position. It would have been tough for them to hold that. And then of course Micron went down for the rest of the day. So that's just one example. That's a stock I traded. But look for these reversals around the London close and don't keep your stop losses too tight during that time. All right, and last but not least, if you are trading small caps like ALDX here, today it's traded about 1 million shares, but I was actually watching another famous YouTuber trading this, and he had a position and he was going to hold it for the rest of the day, but he wanted to get away from his computer and he wanted to set a stop loss and just let it ride. Unfortunately, he set a super tight stop loss, and it really wasn't that far away from price. So with really small caps or even micro caps, if something trades less than 500,000 shares or less a day, and you are trading those stocks intraday, my suggestion is to sit and watch them until you're ready to get out. The reason being is it's really easy for market makers to manipulate these stocks on the short term. And from my experience and my perspective, generally, say NASDAQ market makers, they might have 20 or 30 stocks that they watch during a day. So they're responsible for a whole book of stocks, and they watch 20 or 30 names. Generally, there isn't something going on in all those names every day. So they really only have, 3 to 4 that have a lot of action, and the rest of the stuff is just kind of over there, and they make a market in it. They let some algos do the work and that kind of thing. So this ALDX, which is a $7 stock, today it's traded 1 million shares, but some days it trades 500,000. This may not be their biggest priority. They've got bigger names in their book with a lot more money and a lot more risk associated, so they're watching those stocks. So what am I getting at? They can manipulate this over the short term for 5 or 10 cents really, really easily. And honestly, I've seen it before. They will literally, if you put a stop order or a stop limit order out there, it's very close to the market. They don't even want to have to worry about it. So if there's a stop loss up here at say 760 on this ALDX, and looking at it from 12 noon, it's really easy. This thing doesn't trade. You can see times and sales. We're approaching the close, right? When most stocks are really trading quite a lot, this thing's quieted down quite a bit. It's really easy for them to just bump this, 10, 15 cents or whatever they need to do to just take out your order. And they're not really doing it to be malicious. They just don't want to have to worry about it because they're looking at bigger things, other stocks. So with these kind of stocks, you either have to keep the stock farther away so they're not kind of inclined to just dismiss it and get it off their books so they don't have to worry about it. Because if they know it's there, they can just buy shares up to this point, and if nothing's going on, all these people will move and they give it to you at the highest price, and then it drops right back down. So small caps or micro caps, I would suggest sitting with your position with your finger on the button, and then maybe having a stop loss way out of the way for safety. But As long as it's not the open or something like that, I think you should just keep your fingers on the keys and not put something really close, because they're probably just going to whisk it away because they don't want to be bothered. Just my opinion based on experience, but keep that in mind. It's very, very easy for them to move these over the short term because they just don't trade that much. Since we've been watching this thing hasn't even traded 1,000 shares. All right, before I wrap this up, I want to give you some ideas about how, if you're not in a position, you can look out for these stop runs and you can take advantage of them and you can scalp them. So if you're watching a stock but you're not in something, start looking around. Hey, where would people likely place their stops? And we've already talked about the places where you shouldn't put your stops because that's where everyone's going to be. And obviously you've got option prices, you've got the main levels, support and resistance, all that kind of thing. So you can be on the lookout. If you're not in a trade, be on a look for what's potentially a stop run. How can you trade them successfully and safely? I wouldn't take them at highs of day or lows of day. So that's where you get into breakout, breakdown territory. So don't look for something that's approaching the high of the day as a potential, oh, it's a stop run, I'm going to try to scalp it. That's where it's dangerous. So Micron in this case, it peaked up here, 1030, and then it retested a couple times. At this point in time, I don't like things after they retest 1, 2, 3, or 4 times. I do feel like they're going to break out, and this could potentially be the high of the day up here. So I wouldn't necessarily say, oh, this is a stop run. At this point, it's really not. It's been running for a while, and it consolidated here. So after the stocks come off quite a bit down here, now you've got some, essentially, you've got higher lows, and it starts bouncing off of 51. So I'm not saying those are, the perfect stop runs, but that's the idea. Look for those spots, and these are a lot more low risk because you're not at the high of the day or the low of the day. The thing to remember is you want to go ahead and get in here, get aggressive. There's going to be liquidity at these levels, especially after a run up like this. People are going to be looking to take profits. So the way I do it is I throw a limit order out there at the figure right before. So this would be 50.99 or 51. And I'm ready with either a super tight stop loss. This shouldn't go, for Micron, it shouldn't go more than 3 cents against you, especially considering the ATR here, right? 3 cents. So I don't give these very much room. Either they turn for you right away or they don't. The other thing you should do is use a time stop loss on these. You shouldn't have to sit on them for a very long time either. For me, most stocks, when I'm doing this kind of play, I give it 3 minutes max. If it doesn't move in my favor, at least a penny or more, in 3 minutes, I just get out. All right, so just to recap, the things we went over is average to range. Use a 14-period ATR on your chart and use it to guide your stop loss size. And that will change throughout the day. That's a measure of volatility, so that'll keep you safe. The main levels or the round numbers. So depending on how big your stock is and what the price is, it could be the 00 level and the 50-cent level, or it could be 0 quarter 50.75, or keep in mind where the options are priced. It could be those levels, so check that in Trade Armor. It's very easy to just check and see where the options are for your stock and what might be in play right around this its current trading range. Volume weighted average price. You don't want to rely on that too heavily to guide you early in the morning. It just doesn't have any benefit there. There's too much price discovery, so much hasn't happened, and the large orders haven't hit the market to show you the true direction of the day. 11 to 11:30 a.m. Eastern Standard Time is when the London Stock Exchange approaches its close. So it closes at 11:30. You want to be on the lookout for kind of mini reversal moves during that time. If you have a super tight stop loss and you are short or long, the market may move in the opposite direction just to kind of stuff and give the London traders the worst prices possible. And last but not least, small caps or micro caps. Be very careful putting stop loss orders on the books that are really close to the current market when it's not trading a lot. If they don't trade a lot, it's very easy for the market maker to just dismiss your order, take it out, and have the market come right back down. Add this to your toolbox and look for places where people would get stopped out, and then you could trade off those levels too. It'll give you an extra trade or two for the day. So that's it. I'm going to wrap it up here. I hope that was helpful. Let me know what you think. I'm curious about how much of this you guys knew already, but I wanted to share it with everybody just in case. There are a lot of new traders out there, and they may not be aware of all these things. So If it was beneficial, please hit the like button, share this, subscribe. You'll be notified when I make another video. I really appreciate the support. As always, you guys have been great. It's fun to talk to you in the comments and see what's going on with everybody. Everybody's doing something different, and I'm learning a lot myself. So thank you, and I will see you next time. Be careful out there.